everyone and welcome back. By far, one of the most common questions I get, especially from younger people, is how can I start out with real estate investments? And unfortunately, a lot of the times I have to tell them that real estate probably will not be their first investment, given the amount you have to save, the high ticket size, and all the processes that you have to go through. So, today we're going to talk about an innovation that addresses a lot of the problems that make it hard for younger people to invest in real estate, which is asset tokenization. We're going to talk about what exactly this means and how asset tokenization will make real estate investments more accessible, especially to younger and newer investors. So let's go over some of the reasons why real estate can be a tricky first investment. The first problem, of course, is the high ticket size, which is the average selling price of a product in any industry. This high ticket size becomes a barrier to entry and means that investors have to save up a lot more before they can actually purchase an asset. The next issue here is what is known as the hassle factor. There are a number of steps you have to go through when you purchase a property, such as drafting a sale agreement, registration, payment of stamp duty or brokerage, and you might have to go through some of these steps again when you rent the property out. Even after this, there is a certain amount of property management that has to be done, such as the maintenance of the property, taking care of tenants' needs, and payments of regular dues such as property tax. Real estate, by its very nature, is an illiquid asset and it can take time to complete a sale and convert this asset into cash. The idea behind asset tokenization is not new and it involves creating a token or proof of ownership tied to an underlying and possibly physical asset. With a large high ticket size asset like real estate, the idea is that the creation of smaller tokens tied to ownership can make real estate way more accessible and liquid as an investment. While there are existing ways to do this, these days, asset tokenization involves the creation of a digital token or proof of ownership using the blockchain protocol that is then tied to an underlying physical asset, in this case, a property. So let's have a look at some of the existing methods being used to make real estate investments more accessible. The first such method, of course, is fractional ownership. Here, the idea is to let investors buy a smaller fraction of a rent-earning property while still enjoying the benefits of capital appreciation and rental income. Here, one of the more popular business models is to create an SPV or special purpose vehicle, which is essentially a company that will hold this one single rent-earning property. Different investors are then sold shares of this SPV and are in effect buying a fraction of the rent-earning property. Once again, given the high ticket size of premium rent-earning commercial properties, it means that buying even a fraction of these properties can set you back multiple lakhs of rupees. The next existing method of making real estate more accessible is, of course, REITs or real estate investment trusts. Here, a portfolio of rent-earning commercial properties is grouped together and listed on the stock markets as a REIT. These REITs contain various SPVs as well, and the entire structure is designed in a way to maximize the distribution of rental incomes to shareholders. Since REITs are listed on the stock market, this greatly reduces the hassle factor and, depending on the trading volume, also makes them way more liquid than a physical asset. Given the minimum lot size of 200 units, the minimum investment in REITs tends to be above 50,000, which is obviously much lower than what you would be looking at for an actual property, but is still significant for new investors. So now let's talk about the new wave of blockchain-based asset tokenization solutions that are disrupting real estate. A lot of this is being done through NFTs, which you may have heard about. NFTs are non-fungible tokens, which are unique, non-replaceable tokens created using blockchain, which can be tied to an underlying asset. However, compared to a cryptocurrency, which is fungible because one Bitcoin is the same as any other, in comparison, each of these tokens is unique and is tied to a specific underlying asset. NFTs have been used to represent the ownership of digital items such as music or art and are slowly being tied to securities and physical assets as well. All over the world, traditional real estate institutions are partnering up with technology companies to explore the tokenization of real estate related debt and even equity in real estate. So what are some of the advantages of using a digital ecosystem and blockchain-based tokens like this?
Firstly, this can be used to drastically reduce the capital requirements for investment in real estate. Some of these startups selling tokens in rent-earning properties allow you to invest for as little as $50. This also opens up a host of new options for investors, as ownership through a digital token means that investors can look at properties that are not immediately around them or in different markets. Since this is built on blockchain, this provides an additional layer of data security as well. One of the main issues we spoke about earlier was liquidity, and the creation of these digital tokens solves a lot of that. Such a system would mean that you can have immediate settlements on your fraction of a property, and the hassle factor is completely removed. As compared to a fractional ownership scheme or a REIT where you get shares either in an SPV or in a listed company, here you get a digital token that is similar to a cryptocurrency. While it is stored digitally like a cryptocurrency, these tokens are different because each of them is unique and each one is tied to a specific underlying asset. Finally, because all of this is done digitally, it reduces the amount of intermediaries and the additional costs one has to pay. However, it is important to note that this is an evolving technology and hence asset tokenization is a brand new landscape. There is a degree of ambiguity when it comes to recognizing these tokens as a security in itself. Given the ban on cryptocurrencies in India, it is interesting to see how the government will react to the creation of these digital tokens and NFTs. Some experts suggest that their treatment will depend largely on the kind of underlying assets that they are tied to. For instance, a token created for a piece of digital art will be treated differently as compared to a token representing a share in a property. An innovation like this can also change the landscape for real estate in terms of the amount of capital that the industry has access to. In 2019, a $36.5 million residential building was tokenized in Brooklyn, allowing investors to buy smaller shares. More recently, a company called Liquify is working on digitizing and tokenizing a $600 million luxury hotel in Mayfair in London. Given the momentum behind blockchain-based technologies and the obvious benefits of asset tokenization when it comes to improving access and liquidity for real estate investors, I see this being a popular option over the next few years. I hope that this video gave you a clear understanding of what asset tokenization is and how this innovation could make real estate more accessible for you as a new investor. As always, if you enjoyed the content, please do like the video and subscribe to the channel, and I shall see you again next week. Thank you.